All right, so welcome everyone to Investing 101. Again, I'm here with Kathleen today. We'll both introduce ourselves and tell you more about us, but the goal of today is to teach you really just the basics of investing in the stock market. So what does it mean to open an investing account? How does investing relate to retirement? How can you actually invest your first dollar online? And really importantly, how can we beat inflation by investing? So we're going to talk about all of that today. But before we get started, I'd love for everyone, I know I had you drop your main questions in there, but if there's anything else that would be helpful, we'd love to know where you're at in your investing journey. So number one, I haven't started, but I'm excited to learn. Number two, I have some money invested, but I don't really get it. And number three, I have money invested, but I'm here to see what else I can learn. I think we've heard from just about everyone, but if someone else has joined us and you haven't answered yet, please drop that in the chat so we can reference it as we're going through the presentation today and just know where you're at in your investing journey. So as we get started, I'm actually going to hand it off to Kathleen to introduce herself, and then I'll tell you a little bit about my investing journey.
Perfect. Hi, everyone. I'm Kathleen Marcel. I am the founder of the Financial Reframe, and I started my investing journey when I was 25 by contributing to a 401k, the kind of minimum amount to get my employer match. But I didn't really know what that was or understand anything besides that. And when I was 27, learned about the power of compound interest, and that got me really excited about what I could be doing with investing to be able to really grow and start building wealth. So I was able to figure out how to maximize my contributions through my employer plans, how I was able to create a taxable brokerage outside of that. And over the kind of more recent years, have started investing in real estate as a way to continue to diversify. So excited to have you all here and chat more and start off your investing journey.
Yeah, thanks, Kathleen. So I'll introduce myself. I think a lot of you know me if you're already on my email list, but I'm Annie Cole. I am a financial coach and I'm the founder of Money Essentials for Women. If you know my story, I started off as a social worker making $26,000, quickly realized I was not going to be able to really do a whole lot, including buying a house and having kids with that salary. So over the last decade, learned everything I could about how to make more money and have made tons of transitions in my life. Investing has been the number one thing I have done to get closer and closer to financial freedom. So I just want to paint a picture though. My first real job, I graduated college and I was 21. I could only invest $20 a month. That was truly all I could set aside and pay my bills. So if that's where you're at right now, just know that that is okay. And that is a wonderful place to start. Investing is actually more about the habit than the dollar amount. And the more you start doing it, you'll be able to add more over time. So just know that that is something that no matter where you're at, you can invest as little as $1, honestly. So my story, I climbed the career ladder and started to set aside as much as possible. This year, I'm at about $380,000, and it continues to grow, of course, because of compound interest. And then also added real estate investing a couple of years ago to my portfolio so that I'm diversifying across the stock market and real estate. We won't be diving into real estate today, but that's something that Kathleen and I both have experience in. So if you do have questions about that, we have lots of resources we can share after this event today. So what you're going to learn today, there are 4 key things we want to talk about. Number one, what you need to know before you start investing. So we don't want you to just jump into investing and throw some money into crypto and not know what you're experiencing or what your plan is. We want you to actually have some things in place before you start investing. So we're going to start with that. Then number 2, we'll break down what is investing and why it's important. We want to have a really strong why and a really understanding of the what before we jump into the investing. And then number 3, we'll talk about investing itself. So the step-by-step guide on how to invest. And then number 4, we're going to follow up with just some insider tips and things that we've learned along the way that are really helpful to make it even better when you are investing. And then at the end, stick around. We have some really great bonuses, including some free resources and free consulting sessions with one of us. So we will be sending that at the end of the workshop. So step number 1, investing, what you need to know before you invest. This is really, really important. I know that a lot of people get excited about investing and they open an account and they want to just start throwing money in and seeing it grow. That's really great, but you want to make sure that you're taking care of your overall financial picture before you step in. And there's really this 5-step process that I want to walk you through. A lot of people will call this the financial order of operations. And it's really just best practice in what you do with your personal finances. So, number one on the left side here, have a clear financial vision and goals. So, for example, if you want to be working until you're 65, that's going to be different than if you want to only work until you're 55. If you want to continue to have a rent payment or a mortgage payment all the way through your lifespan, that's going to be different than if you want to pay off your home early and have no mortgage into your later years of life. So that kind of vision and goals of what you want your life to look like is going to impact how much money you need to live that lifestyle, which then trickles down to everything else. So we want to start with that clear financial vision first. And then number two, we turn that vision into a budget. So we actually know how much income we need to cover our lifestyle and what the expenses will be. And we have that really dialed in as a spreadsheet or a budget that we can look at and reference. And then we want to prepare ourselves for an emergency. So before we start putting money into an investment, we want to make sure we have a cushion. So number three, we want to have an emergency fund of savings, usually somewhere between 3 to 6 months of living expenses is best practice, but even truly having $100 set aside, something that you can use as a buffer is going to be important. And then number four, we want to think about debt. So once you have your vision and you have a cushion, then you want to think about debt before investing, because if we think about comparing investing to debt, debt can have high interest, especially credit card debt. Let's think about, 25 to 30% interest on your debt versus potentially earning 7 to 10% interest on an investment. You're gonna maybe lose out if you're trying to not pay off that debt and go straight to investing. So that's why we want to focus on debt first. Once you have all four of those things really, really dialed in, then it's time to go to investing. And investing is where you make your money grow. It's compounding on itself. You're doing things like investing in the stock market, stocks, bonds, ETFs, real estate, businesses. We'll get into all of that, but just know that that is going to be the last step in the process once all of those other pieces are in place. So I'm going to go over each of these other pieces just really quickly to give you some more tips, and then we'll get into the meat of investing. So clear financial goals, a lot of people fall short in that they just totally skip this step. They don't even know what they want out of life. So their goals are too vague, or they focus on, hey, I want to get this job, but they don't say, I want to make this salary, or I want to have this income. So how to do it right, get really specific about what you want in your life, not just in your finances, and then tie your goals to your overall life outcome. So for example, I want to earn more money so that I can buy organic groceries and prioritize my health. I want to work only 20 hours a week so that I can spend time with my kids and watch them growing up and drive them to and from school. That's going to be a good vision that then trickles down into the next step, which is your budget. So once you have your big picture vision, then you'll start breaking it down into numbers. So a lot of people fall short here in that they have maybe a vision, but they have no idea how to turn it into a budget. Very, very normal. Or maybe they're just avoiding their finances overall. They don't want to check their bank account. You have low income right now. You have a lot of debts. It's just causing a lot of stress and you want to avoid it altogether. So how to do it right? In a non-judgmental way, sit down with your finances and know what your key numbers are. So these are the main things. And again, we'll send out this slide deck so you can reference this, but you want to know your income and your expenses. And then you want to know your total savings, debts, and investments. That's going to give you a really holistic picture of where you're at with your personal finances right now to know what to do before you go into investing. And then step number three, your emergency fund. A lot of people don't have anything set aside for an emergency. So again, instead of living paycheck to paycheck or spending everything you have, start small, set aside $20 each month, aim to save 3 to 6 months of living expenses. But again, start small, set aside whatever you can so you have at least a little bit in a savings account. And then again, think about your debt. So if we don't attack our debt first, investing is just going to not help us holistically think about our finances. So we want to do a little both and. We want to think about debt and investing. So if your debts are high interest, if they're somewhere between 12 and 30%, you probably want to tackle that debt first, or at least tackle a debt alongside your investing strategy. If your debts are low interest, like a student loan, I think I have a student loan that's at 4%. I'm making the minimum payment on the student loan while prioritizing investing. And we can go into more depth in a one-on-one consultation with you about this, but just there are different ways and priorities when it comes to tackling your debt and investing and which to prioritize. So once you have all that laid out, you're ready to start investing, which is what we're here to talk about. So Kathleen, I will pass it over to you. Oh, sorry, you're muted.
Thank you. All right. So what is investing? So if you already have a retirement account, maybe you've been contributing to an IRA or your 401k or some sort of plan at work, you're already an investor. And what we're going to chat through is making sure you understand all of those different options so that you can make the decisions that best support your goals and where you want your wealth to be able to take you in the long run.
Thanks. And Kathleen, I can talk through this the next couple slides first and then have you go into the meat and potatoes of investing.
Sure.
So this one, just to introduce everyone to this idea, a lot of people, when I was first investing, I had no idea what the stock market even was. It just seemed like this foreign concept of what is it? So you put money into the stock market and it grows, but why does the money go up over time? So I want you to think about this scenario, which explains how the stock market came to be. So on the left-hand side, we have these two people, Maggie and Matt. Let's say they're just random people that decide to start a donut business. They have $500. They start their business. At first, they're just working on their own. And then one day, everyone finds out about the donuts. They love them. Everyone starts buying the donuts. So they start opening up a shop 5 miles away and then 10 miles away. And then they open up a shop in another state. And pretty soon, they have 10 shops across the US. And their business is flourishing so much that they think we want to keep growing. We're going to put our business in the stock market so that we can actually allow other people to give us their money to grow our business. And then as our business flourishes, we're going to give a portion of our profits back to the people that gave us money. So it's basically letting the business become a part of this entity called the stock market, where individual people like you and me can give businesses our money and then get money back when they're successful. So as you can see over here on the right side, the average person can actually buy and sell pieces of a business by putting money in the stock market and then getting money back when the business is profitable. So for example, let's say you give Google $500 and they give you a chunk of their earnings. This is what it would look like. So you have $500, you go to this place called the stock market online, you look at a list of different options and you think, hey, I see some Google stock. I'm going to give Google $500. And then as Google grows and makes a lot of money, I'm going to have more value in the company. They gave me an extra $100 because the value of the company went up. And now I'm going to sell that off. I made a profit, or I had them, they paid me a dividend and I made some money. So this is just a very cursory overview, but this is what it means to invest in the stock market and how you make money. So honestly, investing in the stock market is just like buying any other asset. So if you think about buying a car, let's say you find an old car that's actually worth a lot of money because it's rare and you pay $20,000 for it. You spend $1,000 fixing it up, making it fancy, and then you sell it for $50,000. It's the same thing when you're investing in the stock market. You're giving a business your money, and then as the business grows, it increases in value and you can sell it off to then make that profit. So investing in the stock market is giving your money to a company. You're basically becoming a co-owner in a tiny way of that company. When they win, you win, and when they lose, you lose. So this is why education is so important in this process, because if you were to make potentially a risky investment in a brand new business that does not become successful, you would lose money. Versus if you put your money into specific investments that are more of what we would call gold standard investments, you're going to have a higher chance of getting a return, even though there's always risk involved because you are giving your money to a business and we can't guarantee that there will be a return. So Kathleen will go into more depth on this, but this is just a quick overview of what it means to invest in the stock market and how it all works. All right, so Kathleen, let's break it down a little further.
Perfect. All right. So let's start with why should I care? One of the main things that I hear from clients are, I wish I would have started this 5, 10 years ago. And the reason that they say that is because that's when they start realizing that time is really the most important component when you think about investing. And I have this little scenario written out here. We'll talk about Sarah and Lisa. So Sarah started investing at age 25 and $500 a month. And if we estimate a 7% annual return, and just for some context, so on average, over the last 30 years, the US stock market has averaged 10% annually. And so the reason that, oftentimes in these kind of scenarios, you're talking about maybe 7 or 8% is because we're factoring in inflation. And so when we think about these numbers, if we take out inflation now, that is going to help you understand of in today's dollars, what does this turn into? So just in this scenario, someone starting at age 25 with $500 a month with that 7% annual return, by age 65, they would have 1.2 million in today's dollars. Okay. And then thinking about someone that maybe doesn't start this investing journey until they're 35. So 10 years later, investing that same amount with the same returns, at age 65, they have $567,000. So still a great amount of change, right? It did certainly compound their dollars. But it's important to understand that, having time on your side will help. So in this scenario, their returns more than doubled because of just starting 10 years earlier. All right. So Annie kicked this off at the beginning with talking a little bit about inflation, right? And I'm sure we're all feeling this in just the past couple of years with how much, inflation has been going up. And so what we want to think about is how can we kind of best protect ourselves and set ourselves up to make sure that we're continuing to build wealth, even when we know we're always going to have to deal with inflation. So I wanted to share just a few different numbers that you can kind of think about in terms of where is the best place for me to store my dollars, depending on what I want those dollars to do for me. And so the way that I think about it is we first need to understand what the average annual interest rates are. So how much money am I going to get every year for putting my money in a certain place? So if you just have a standard savings account, take a look. You'll be able to see in your bank what that's at, but typically it's very low. It's something like 0.01%, which essentially you're making, pennies, maybe a dollar on whatever you have in there. There's something called high yield savings accounts. If you're not familiar, a great place to park your emergency fund because you can get something like a 3 or 4% interest. Okay, so at least you're making some sort of interest on that money. And then in the stock markets, again, I shared the stat of over the past 30 years, the US stock market has averaged 10% annually. And we'll talk more about this. It's not going to be kind of that flat rate, right? It's going to go up some years, it's going to go down some years, but this is just the average over all time. So we don't know what the future holds. But if we take a look back at the last 30 years, it's averaged around 10%. So it's just helpful to understand kind of how these different buckets or where you're storing your money, what that can potentially do. And the other piece that we need to keep in mind then is inflation. So on average, we think about 2 to 3% every year. That's going to have inflation, kind of how you want to think about that. But over the last 5 years, it's actually been much higher. And it has been around 5.5%. And so that's why we talk so much about investing and make sure that people really understand what it is and how they can use it to their benefit. Because even a high yield savings account that's making 3 or 4%, if inflation is also at that same rate, then you're basically just kind of keeping up and not making any money. And that's why investing is such an important tool to really understand how to kind of combat the inflation that we're all dealing with.
Thanks, Kathleen. And really quick, just a question. I'm asking because I did not fully understand inflation when I first started investing. I had heard the term, but I didn't really understand it. So can you give a quick explanation of what inflation is?
Yeah, so essentially, as the kind of more money is being produced and there's more money in the overall economy, our prices have to rise to keep up with that. So it's always going to happen. But the amount that that is depends on many different factors. And that's where it can change of how much money the government is putting back into the people's hands, if you will. But that's how you can that's going to give us an annual number, and prices just have to rise to keep up with that.
Gotcha. Okay, thanks so much.
Perfect. You can go to the next one. All right. Um, so we're going to talk through the different types of accounts that you can use to invest. So I'll give you the high level here, and then I have a table where we'll break it down a little bit further. So if you have an employer plan, so that could be a benefit through your job, is you actually have some sort of employer sponsored retirement account. And these can be kind of different things, but if you heard of like a 401k, a Roth 401k, a 403b. Those are different types of employer sponsored plans, okay, where you can actually take money directly out of your check and go into one of those different vehicles. If you maybe do not have a job that would offer that type of benefit, you still have access to adding or contributing to a retirement account. You could open your own Roth IRA or a traditional IRA, and I'll talk later about what the difference is. And then you also have an option to open a taxable brokerage. So this is something completely separate from a retirement account. And the biggest difference being that you would be able to access that money earlier. So with retirement accounts, they have strict age limits. So you typically cannot take money out of those accounts before the age of 59 and a half. There's some kind of caveats to that, but in general, it's once you're 59 and a half. So I always like to just make sure people are educated on the employer sponsored plan. I think it's great because it is money that, again, comes out of your check without you seeing it. So if you are just getting started investing, it's a great way to kind of get started because it's automated, you don't see it, and it completely removes that emotional element of you having to do something every month. It's more of a kind of set it and forget it motion. Yep. So here's the different account types kind of all laid out here. So the traditional retirement, again, that's something that your employer would support for you or give you access to. And for all of these, well, the first three, there are going to be different limits. So that's something important that you want to be mindful of. And you can ask your employer, you can take a look. We have the limits here. They change every year. So for a traditional retirement account, you can put up to 23 and a half on an annual basis. And so the nice thing about these types of plans is that they're all pre-tax. So you are not paying any tax on the money today. It goes before tax, it goes into this account and you can invest that money. And so it's going to be growing, and then you pay tax later on once you take it out. And then there's other types of accounts which would fall more into the kind of the Roth buckets. And that's the biggest difference, is that on your Roth dollars, you are paying tax up front. So even if it's an employee plan, they're taking that tax out, and then that money is growing tax-free. And so there's pros and cons to both, right? We don't know what tax bracket you're going to be in. We don't know what tax is going to look like overall once we come to that retirement age. And so again, when we think about kind of taking risks and wanting to diversify, it could be beneficial to put dollars in these different buckets. So you have some that you already paid tax on, others growing tax-free. But those are kind of the important things to understand, is how it's taxed and knowing that there are limits. And if you're someone that is interested in possibly retiring early, then it's really important to think about how you could add a brokerage account into this full portfolio. And a brokerage account, there's no limit. You can contribute as much as you want. It's all post-tax dollars. And then that money will grow there. You can take it out at any time, and you're paying a capital gains tax. So there's kind of short term, which is a little higher, or a long-term tax rate, which would be a bit lower. So all just important things to just kind of understand. And the other part that I want to make sure is clear is that these are kind of more of the vehicles in which you can invest. And then we'll talk about what do you actually invest your money in. So this is just how am I going to invest? And then we'll talk about the what. So any questions on that? Because I know that part can be confusing sometimes.
One thing I'll add, and feel free if you're thinking of questions, drop them in the chat. But I think the brokerage account was something that I learned later on. You know, people always tell you about the 401k, start a retirement account. A brokerage account is really amazing because it has no limit and you can pull it at any time. So again, just to echo what Kathleen said, if you're thinking about retiring early, this is a great type of account to add in. You can set it up completely on your own in a Vanguard or wherever you keep your monies, in addition to a regular retirement account, and just put money in on your own. So it's something really great to check out in addition to the traditional accounts. All right.
All right, so we'll go through a few different scenarios, just so you can kind of understand the impacts over time and also the impact that this can have on your tax situation. So here in this example, we have Kelly. She's 22, starting a job for 50K. And then you can see over here on the left, so she sets up her 401k through her employer. And so she's contributing $23,000. And so remember, this money is coming out pre-tax. Okay, so she's contributing 23K. She's also going to get a 3% match from her employer. And you want to think about 3%, you're taking your salary. So hers is 50K times 3%. So that's $1,500. Okay, that's how you're getting or kind of understanding what your match is. So that means she's investing 24,500 a year. And we just wanted to highlight kind of what this would mean for your tax situation. Okay. And it's a pretty big difference because, you know, typically $50,000 salary, let's just use 30% of what you're being taxed on that. So she would owe 15,000 in taxes. Once you, with kind of that other scenario of contributing to retirement, that is taken away. And so your 50,000 salary, we're actually taking off the amount that we're putting into retirement, and then you have your tax rate after that. So you can see your taxes are almost cut in half because you're contributing to the 401k. And then over time, which is what you're seeing on the right here, is how this is compounding over time. So, you know, this we're using, you know, she's young, she's 22. We're saying this is going to grow over 43 years at 10%. And then we're up to 13 million while getting that immediate tax break. So I think it's really helpful to just have some of these different scenarios, and we'll share a compound interest calculator later for you even to just kind of put in some different numbers and see what this could look like for your specific situation.
Awesome. We also have a quick question in the chat. Kathleen, feel free to share or I can answer. Is a brokerage account still a good idea if starting late?
Yeah, I would say I would think about you can start at any time for sure. I would think about kind of where you want what does your future retirement look like, right? Where do you want this money to take you? And that's going to determine the goals, right? Because if you don't want to retire until you're, let's say, 65, and you have access to a employee sponsored plan for tax reasons, right? Maybe you can save on taxes now, that money can grow faster. But if you need to access it sooner, so it's all going to be just depending on what your goals are what you're looking to do. But either can make sense. So regardless of, if you're starting later, that's still a great vehicle.
Yep. Another thing I'll add is that when I first started investing, I always thought about investments as a pool. Like I have a IRA, a Roth IRA, I have this old retirement account from an old employer, I have a new retirement account, and I'm just gonna drain one account at a time. I'm gonna use all of the one from the old employer, then all the one from my new employer. But actually, if you work with a licensed investment manager, they can help you create a plan where you do a variety of things. So you could, when you're younger, just pull from your brokerage account. And then when you're the oldest and you have probably the highest expenses, you're pulling from your Roth, which is not taxed. So you could do them in a certain order to minimize taxes. Or you can do something where you're pulling, let's say, from 3 different accounts, 1/3 of your money for each year is coming from each account so that you're not draining them all at once. So there's lots of different ways you can use the accounts in different varieties to try to figure out the most amount of income you can get and pay the least amount in taxes.
Yes, we'll go through a couple different scenarios here. So again, a different scenario, Kelly here is not employed, so she doesn't have access to like a 401k that we talked about. She still is able to set up an IRA account. The maximum amount is lower, so that's going to be $7,000. She's not going to get an employee match. But you can still save on taxes that way. So depending if you're putting that into a traditional IRA or a Roth IRA is going to depend on kind of the tax benefits like we talked about. But this is a way where you're putting that money away for the future, continuing to grow, that you'll be able to access later on. And then a caveat that I feel like is not well known is that IRA funds can be used. There's different kind of legal ways you can pull it out for purchasing a first-time home, if you had medical or college expenses. So for the most part, you want to think about your retirement accounts really not being touchable until you're 59 and a half. But there are certain scenarios. So it's important to kind of understand what those are.
Yep.
All right, and then a couple other scenarios here. So we talked about the Roth IRA, and really the benefit here is you're paying tax up front, but those withdrawals later on are going to be tax-free. So you're paying tax now, and then that's just going to continue to grow and grow over time, as you can see from some of these compound interest graphs here. So just a couple kind of different ways you can break it down if you're thinking about, okay, this makes sense, but should I do an IRA or a Roth IRA? So in either scenario here, she's maxing out because it's the $7,000 is all we can do if you don't have it through an employer plan. And so again, if you think about the 50,000, taking out that 7,000 for pre-tax, that's going to give her a little bit of a tax break. So she's going to be paying a little less than 13K in taxes. And then on the other side, if she's putting it into a Roth IRA, she's not able to take anything off from a tax deduction because you have to pay taxes up front on that money, and then it will grow tax-free. So a little bit higher in taxes, but that's really going to grow over time, and you're not going to have to pull out your taxes. So that's what we have kind of these scenarios on the end. So if you have a withdrawal plan once you're 65 of how am I going to start using this money? I want to be living on 120K every year. She pulls that out, and then you're still going to have, the taxes you have to pay. Where on this end, you can have that money, you can pull that out, and there's no taxes owed. So that's the important thing to understand when you're kind of thinking about which bucket makes the most sense, whether it's an IRA or a Roth plan. Perfect. And then we've talked a little bit about kind of just a brokerage account. And so let's say in this example, Kelly here is putting in 500 a month, so 6,000 a year. And so, one case like here is she's already maxed out her retirement accounts. So she put in her max for retirement and then for her IRA plans, but she wants to retire early. So she's able to put this money in, and then she really can do maybe experimental investing, right? If she wants to invest in certain stocks. We talked about capital gains, where it's going to be actually taxed less than your kind of standard income. So all just important to kind of understand what the different options are. And we're happy to kind of go into specific questions or the kind of one-on-ones that we can have. We can talk through people's specific situations and what that could look like.
Awesome. And one thing I'll add here for brokerage accounts. So when we're talking about capital gains, one thing to know is that all of these accounts have different taxes, as we've talked about. So, the Roth IRA, you're not paying taxes when you withdraw it. Your regular 401k, you are paying taxes when you withdraw it. The brokerage account capital gains are actually unique. So if you hold long-term capital gains, which means you have held your investment in the stock market for longer than a year, you actually only pay somewhere between 0 and 20% in taxes based on your income. So it's just a lower tax amount. And that is a unique benefit that comes with this. So yeah, just keep in mind, very, very different things that you can do with taxes with these accounts. And we can get into more depth and run some calculations on the exact amount that would make sense for you.
All right, so we're going to talk about walking into the stock market and what are some different kind of pieces here that you have available. So one option is just purchasing a stock. And so that is a piece of a single business. And this goes back to Annie's example earlier with the Google stock, right? Or our donut shop, like one stock and saying, I want to put my money in this. This case, we see Amazon here. So if Amazon does really well, great, I'm going to make some money. They don't do so well, that could be really risky. I'm essentially putting all my eggs in one basket. A mutual fund is when you are working with an investment advisor and they are investing on your behalf. And they will make the determination kind of based on your goals and your contributions, all of that, where they're placing that money, and that can be into a number of different places. And then the part that we'll talk a lot about today are index funds and exchange traded funds, commonly heard or known as ETFs. And so with both of those, instead of saying, I want to put my money into just one company, you're actually doing more of this fund model, right? Where you can put your money into maybe the entire S&P 500, right? So the US, like our 500 largest companies, or you could do something like the entire US stock market. And so essentially what you're doing is it's this huge piece with many, many, many different companies. So even if a few of those companies do not do so well, you're going to have other companies that do very well. So from a risk perspective, this allows you to diversify a bit more than putting your money directly into one stock. So it's basically this fund or this group of stocks that you can put your money into without you having to choose these individual companies. Yep. So let's see here. I think we talked through all of this. Yeah, the bond is going to be kind of the least risky, where essentially you're loaning money in exchange for interest. So especially as we get kind of closer to retirement, and we want to make sure that we're a bit more conservative on our portfolio because we're going to be living off of this money sooner, bonds can be an important part of your strategy. So just another kind of option that you have to invest in. All right, and a very important part of, we talked through the risk factor. The other part that I always like to talk about are fees. And Oftentimes when you look at fees, you're like, okay, 1%, that's nothing. It doesn't seem like a lot, but when we think about compounding over time, it can really make a large impact. So it's just so important that you understand what you're investing in and then what the associated fees are. And so we have some kind of examples here. So a mutual fund, if you're working with a financial advisor, it's very common that that's going to be, almost a percent that you may be paying in fees. And index funds or ETFs, you can typically find those for much lower in terms of what the fees are. So just something that you want to make sure you're aware of when you are kind of putting or choosing these different investment options, even if it's within your 401k account, right? Maybe you already have a 401k account. Go in there, take a look. What is my 401k invested in? Okay, what does that look like? And then what are the associated fees? Because that's all going to really make an impact on the overall compounding and the way that that's going to build over time. All right, so what do I need to do? I know some of you kind of raised your hand at the beginning and said this is new. So we're going to walk you through step by step. So after this training, you have all the tools and what you need to go and start investing. So a few key things that are important to know. It's really important to diversify. We don't want to put all of our eggs in one basket, right? Taking all of my investment money and saying I'm putting it in Amazon, like then my whole wealth is depending on how that one company is doing. So the more that we can kind of diversify, so we can have some wins, some losses, but everything can kind of even out, is going to be beneficial. And then just watching out for high fees, knowing what your options are, and then remembering that this is a long-term play. And we talked about the stock market, having those 10% averages. There's years that the stock market is in the negative, and there's other years like we've seen recently that are, upwards of 20%. So it's going to ebb and flow, and I'll kind of show you some stats here in just a second. But those are just important things to keep top of mind. And so thinking through, ETFs or index funds that are a collection of stocks bundled together. And that's going to save you a lot of time. You don't have to worry about, picking individual stocks that are going to be successful. You can automatically diversify just by using these funds. And then they're also lower cost because you're not paying anyone to manage them. So again, it just kind of all ties into the fees and just knowing what your options are. Okay. So a few reminders that I wanted to share is every investment does carry risk. So by investing, you're basically giving your money to someone or a company, and there's things that we don't know what's going to happen, right? How well are they going to do? How well are they going to perform? And so it really, the most important thing is thinking about your time horizon, and that's going to determine the amount of risk you're comfortable with. If I need this money in 5 years, maybe putting it all into the stock market may not be the best option, right? But if I'm thinking about a retirement in 30 years from now and I have time to kind of weather the ups and downs, then it could be a really good option. So just understanding what you're saving and investing for and what that time horizon looks like. And making sure this isn't money that you need today. So Annie talked about having an emergency fund set aside, making sure you're thinking about setting cash aside for some of those short-term goals, and then how do I invest and have investing as part of my longer-term strategy. And then, not reacting to market changes, right? It's really easy, you'll hear it on the news of there's the stock market's going down and people get nervous. And I'll show you some different kind of charts here, but it's just how you react to those fluctuations and making sure you're staying consistent and understanding what your long-term goals are can help you build kind of the most wealth over time.
Yeah, I don't know about you, Kathleen, but I'll just share for you all an insider tip. I do not check my investment accounts all the time. I think that research would say that people that are going in and checking every little dip, you might be hesitant to make changes, when honestly, the accounts that just stick and don't make changes over the long run are going to get the best returns. I don't know how you feel about that, Kathleen.
Totally the same. Yes.
Yep. Yep.
And I want to make sure we have time for questions. So I'll go through just a couple of these briefly, and then I'll pass it back to you, Annie. This I wanted to share because I think it's just so interesting. This is the US stock market since 1870. And you can see, I love how they kind of call out these dramatic drops, and they kind of tell us, okay, what's happening. So, something like the crash, right? The Great Depression in 1929. Like, people here, you would have been nervous and think, okay, this is like the all-time low. I need to sell everything, right? But over time, it always goes up. So even kind of things a bit more recent that we can all remember, 2008, right? The huge market crash. People get scared and you sell, but over time continues to go up. So it really is a long-term gain. Again, we don't know what the future holds, but if we look at this for since 1870, we've been able to see that it always recovers, even though it can take, a number of years to do so. And then this again is just, you can look at different time frames. So this is looking at since, around like the past 20, 25 years or so, and you can see how things are going up over time. But Annie, if you want to go to the next one. This is if you're looking at more of the kind of, you zoom in for just the past month. And this is why Annie and I don't look at our investments, because something like this could make you worried and like, oh my gosh, am I going to lose money? And so it's really important, instead of having this kind of narrow focus, that you're taking that step back, and, looking at it in a kind of big picture, and not getting worried about the kind of the small changes. So I'll go through this slide, and then Annie, I'll pass it back to you before we open it up for questions. But I thought this was such a great article from JP Morgan about panic selling. And their point here is that missing the 20 best days in the stock market from January 1st, 2003 to December 30th, 2022 could have cut your total portfolio returns by more than half. So that just goes to show of like how you have to kind of weather these storms, and things will go up, they will go down. But I really think that's impactful, of the people that got nervous and said, oh, I'm going to pull my money out, I'll put it in later. They could have cut their total portfolio returns by more than half. So it really is just being confident in your long-term plan and saying, hey, I'm going to let this ride out over time, are going to kind of give you the best results.
Absolutely. Yeah, let's go ahead. I'm going to skip forward a little bit. And again, we're going to send out this slide deck, so you'll get some of the pieces that we're skipping over today. I also have tons of tips and resources here at the end that I can go through, but because we're getting close to time, let's go ahead and open it up for questions now. So I'd love for you, either come off mute, drop it in the chat. What can we answer for you? And this can be based on something we've already covered. We can go back to a slide, specific scenario questions. Let's open it up for questions and get started. And while you all are thinking of questions to drop in the chat, I'm going to actually take us forward through two really common questions in case these pop up. Number one, can I transfer money from one company to another? So I get asked this all the time. What if I have an old account with an employer? What can I do with it? So there's a couple things you can do. Number one, you can leave it where it is. Number two, you can transfer it to a new place. So if you leave it where it is, let's say you had an old employer who had a Fidelity account for you, you can log into Fidelity forever and have access to it even when you're no longer employed with that company. The most important thing is don't forget where it is and don't forget that you have that money, and watch what it was actually invested in, because your employer may have just invested it on your behalf in a target date fund or something, something very specific, and you might want to change that. So over time, just know that you have access to that and you can make changes to what it's invested in. But if you don't want to leave it there, let's say you have a new employer and you've suddenly transferred everything to Vanguard, you can actually transfer that money over to an account with Vanguard so that everything is in one place. So those are really the two options you have. There's some instructions I'm happy to share on how to make that transfer process, but most of the time you start the transfer process with where your account currently is. So if you have an old account with Fidelity, you'd probably open your account, look for something that says roll over my account or transfer my account to a new entity. And that's how you'd start that rollover process. Second frequently asked question, can I have multiple accounts, companies? Absolutely, yes. You can mix and match. So you can mix and match. For example, you can have one at Fidelity, one at Vanguard. You can have two 401ks. You can have a 401k and a 403b. You can have a Roth, an IRA, for example. I have an IRA with SoFi. I have a couple accounts with Vanguard. I have an old account with TIAA from an old employer. You can have quite the mix and match. So just know that that's okay, but there are annual contribution limits. So that's something that Kathleen talked about, I think, a couple slides back. If you are putting money into multiple Roths or multiple 401ks, let's say you have multiple employers in 1 year, you still have those overarching limits that apply to you as an individual and your year of income. So you can have multiple accounts, but think about the limits that are there. And again, as you're thinking of questions, please feel free to drop them in the chat. Happy to pause and answer questions. Otherwise, I'll keep going through some additional resources for you all. I want to jump ahead to the end to get us into some of the resources for today. And we'll just skip through these parts. This, I think, is helpful, again, to show something that Kathleen mentioned. When you're putting your money into a savings account, if you're getting 0% back, you're not making any money on your money. So you're truly just holding your money the same year over year. Versus, let's say you have a bond. I think Kathleen touched on this. Bonds are going to be very, very safe, almost guaranteed money, but again, kind of a lower interest rate. So let's say you earned 4%. You can see already with the $180,000 how much you have earned over time, up to $357,000. Then you go up to an index fund or an ETF, let's say somewhere between 10 and 13%. You're seeing tons and tons of interest gained. And then this was an example. If you were to have been an original investor in Google stock, the highest it would let me go is 46%. But Google stock was, compounding in the 400%. Just you would have had, billions of dollars. So just keep in mind, we think that we're trained from a young age that saving is a safe way to go, but you're going to earn so much more when you find the right level of risk and do have some sort of return on your money. Books that we'd recommend, again, I'll send out the slides, but these are some of our favorite books. Lots and lots of books out there that will walk you through the entire process of how to invest completely on your own. We'll also share these free investing calculators. So you can just go online, look these up. I love the Bankrate one. If you just Google Bankrate retirement calculator or NerdWallet investment calculator, these will pop up, but we'll also share the exact links. It will show you if you were to put in a certain amount of money, what it will grow to over time. And then the last thing I want to share, that we'll send out specific links for this, but we have a couple of giveaways for you all, as I mentioned in the beginning. So Kathleen, why don't you talk about your giveaways first?
Yeah, absolutely. So happy to offer a free money audit for anyone that's interested. So we would just set up a one-on-one call, talk through your kind of where you're at in your financial journey and what you're looking to do. So maybe you're someone that kind of needs some help with steps 1 through 4 before you get to investing. We can certainly tackle that. Maybe you're someone who has all of that down and just want to start your investing journey. Happy to answer questions and give you kind of some strategy and advice to get you on your way.
Awesome. And then we also have a couple investing programs. So we'll share links where you can sign up for our online courses that walk through even more in depth how to actually start the investing process. I think a lot of you have already downloaded a free e-copy of my book, 101 Ways to Build Wealth. But if you haven't, I'll share a link to that. It's 260 pages of tips on how to build wealth, but there is a whole section specifically on retirement accounts and investment tips. And then if you want to meet with someone beyond Kathleen and I, we also have at Money Essentials a directory of coaches that are experts in business strategy, career, if you want to get a new job or spruce up your resume, debt specialists, divorce specialists, all kinds of folks that are experts in very specific niche areas. So we'll be sending out a link to that if you want to do a little bit more exploring. So it looks like we have one question in the chat. Do you invest as well if we give you our money? We actually are not investment managers, but I actually have some recommendations that I'd be happy to share. I have someone based in the US who is a wealth advisor that I've worked with. I also know my husband keeps his money with Fidelity, and he's gone with a Fidelity advisor. All of my money is through Vanguard. I have not asked anyone to invest on my behalf, but can share some recommendations. Kathleen, what about you?
Yep. Same thing. I have some recommendations, but yeah, not something that I personally do as a finance coach.
Yep. Yeah, and that's a great question. Just to keep in mind as you're building out your financial team, a coach a lot of times can work on the educational aspects and do financial planning with you, as well as budgeting and projections and calculations. And then an investment manager or someone like, a certified financial advisor, those folks, if they're working with an investment firm or a wealth firm, they can do that investing on your behalf and manage your portfolio for you. All right, well, I know we're at the hour. I think we'll shut it down. I'm gonna stick around for 2 extra minutes, just in case anyone has questions. Feel free to stick around and ask us questions in the chat or come off mute. Otherwise, thank you guys for coming. We really appreciate it. And we'll be sending you a follow-up email soon with lots of goodies. So thank you so much. All right, I'm gonna go ahead and stop recording so that I don't forget.